They just asked me to update my income. And I said, no, not because I have something to hide, but because I know exactly what they do with that number. And it has nothing to do with helping me. Banks have trained us to hand over our income like it's required. Like refusing would somehow get our account shut down. But that's not how it works. And today I'm breaking down exactly what happens the moment you update that income field and why I stopped doing it. My stay with me makes because by the end of this video, you'll never look at that little form the same way again. Last month, I logged into my credit card account to pay my bill. Before I could do anything, a friendly little pop-up appeared. Update your annual income to help us serve you better. Serve me better. That's what they said. And I closed it immediately because I know exactly why they're really asking. Here's the first thing most people don't realize. Banks are not legally required to ask for your income in most situations. There is no law that says your credit card company must know your salary. No regulation demands updated income information on file. They ask because they want to, and knowing helps them make more money from you. That distinction is everything. Think about the last time you applied for a credit card. That application asked for your annual income. You probably entered it without thinking, because it feels like standard information. Everyone asks. But here's what happened the moment you submitted that number. The bank's algorithm instantly sorted you. Your income became a data point in a profile that determines how they'll treat you, not just for approval, but for every decision they make about your financial life going forward. Let me break down the 3 main ways your income data gets used. And none of them are as innocent as they sound. Number 1, credit limits. Higher income means higher limits. That sounds like a reward, right? But here's the twist. Higher credit limits lead to higher spending. Banks know that people with more available credit tend to carry higher balances. A $30,000 limit isn't a gift. It's more rope. And banks know some customers will hang themselves with interest payments. Number 2, interest rates. You might assume high earners get lower rates since they're lower risk. But that's not always true. Banks use income to measure something called price sensitivity. Someone earning $200,000 a year might not shop around for a better rate. They might not even notice a few extra percentage points. So the algorithm knows, charge more, they'll stay anyway. This is called ability to pay pricing. The more you can afford, the more they charge. Not because you're risky, but because they can get away with it. And number 3, marketing. The moment your income is logged, you get categorized for targeted offers. High earners get bombarded with premium cards at $500 annual fees, personal loan pitches, investment products, insurance packages. Every time you log in, you're running an obstacle course of upsells calibrated precisely to your income bracket. And it's not just high earners who get targeted. Lower income customers get a different, more predatory version. Balance transfer traps, high interest personal loans, credit limit increases designed to enable overspending. The targeting is precise because the data is precise. Here's what makes this worse. That income figure you entered years ago, it's still sitting in your file. Though it's still influencing decisions, interest rate changes, credit limit cuts, account closures during economic downturns. Banks have very long memories. Your data has a very long half-life. Okay, so when do you actually have to give banks your income? And when is it completely optional? Let me be very clear about this. Mortgage applications. Income verification is federally mandated. You'll provide pay stubs, tax returns, employment history. There's no way around this. And frankly, you wouldn't want to. No-doc mortgages were a major cause of the 2008 financial crisis. Auto loans typically require income disclosure too, though standards vary by lender and loan size. Now here's the part that surprises people. Credit card income update requests? Completely optional. The bank asks. They don't verify. They can't access your tax returns. They can't see your pay stubs without your permission. They are entirely dependent on what you tell them. And that tells you something important. If the income data is so critical to serving you better, why don't they bother to verify it? Those periodic income update pop-ups in your account. You are under zero obligation to respond. Close them. Ignore them. They will disappear and return in 3 months. Close them again. Nothing will happen to your accounts. Now, and this is critical, I am not telling you to lie about your income. Providing false information on a credit application is fraud. It's illegal. It's genuinely wrong. Don't do it. What I'm saying is, there is a significant difference between lying and simply declining to provide optional information. When a bank asks you to update mid-relationship, you can close the pop-up. Leave the field blank. That's not deception, that's privacy. Let me tell you about someone I know. She's a contractor with variable income, sometimes $8,000 a month, sometimes $15,000, depending on the project load. When she applied for her credit card, she reported conservatively, based on her lower months. 2 years later, the bank asked her to update her income to process a credit limit increase. She entered her current earnings, substantially higher. Within 3 months, her phone was ringing with personal loan pitches. Her credit card offers shifted entirely to high-fee premium cards. Her mailbox filled with balance transfer promotions designed to encourage debt. She had been reclassified. Her peaceful banking relationship became a full-on sales campaign overnight. She never updated her income again. Every pop-up closed. And within about 6 months, the aggressive marketing faded. The algorithm had stopped receiving fresh data, and her profile gradually decayed back to default treatment. Here's why that matters. Banks' systems are optimized for fresh information. The old income data doesn't trigger the same algorithmic responses as a recently updated figure. That's exactly why they ask so persistently. Every update resets the clock. You become a newly classified target all over again. Consider the asymmetry of this relationship. Banks hold enormous amounts of information about you. Your spending patterns, payment history, debt levels, financial habits. They run sophisticated algorithms on all of it to extract maximum value from the relationship. Meanwhile, you know almost nothing about their internal decision-making. You don't see the algorithms. You don't understand the categorization. Refusing to volunteer additional information simply reduces that gap slightly. It puts you on marginally more equal footing. And here's the powerful part. When the bank has less income data, they have to rely on your actual behavior, payment history, credit utilization, account longevity. Those signals are harder to fake and harder to manipulate. Your actions become your profile, not your claimed income. Imagine 2 customers with identical credit scores and spending patterns. One updates income regularly. Their income grew from $70,000 to $95,000 over 3 years. The other has never updated since the original application. The first customer gets aggressive premium product marketing, credit limits bumped up twice, groomed for higher fees. The second, standard treatment, flies under the radar. Which customer is better served? That depends entirely on what you want. If you want maximum credit access, update everything. If you want to be left alone, minimize what you share. All right, let's make this practical. Here's exactly what I do and what I recommend. 1. New credit card applications. Yes, provide income. It's essentially required for approval, but be thoughtful. If your income is variable, you don't have to report your best month. Report accurately. But don't volunteer more than necessary. 2. Income update pop-ups on existing accounts. Close them, every single time. There is no penalty for ignoring these. They'll return. Close them again. Your accounts are fine. 3. Credit limit increase requests. Ask yourself, do I actually need a higher limit? If yes, income verification may be required. If you're happy where you are, decline. Don't give income data for a limit increase you don't want. 4. Mortgages and required loan applications. Provide what's legally required, nothing more. If they ask for documentation beyond what's mandated, ask why before you comply. And 5. If a bank calls asking you to update your information, remember, phone calls are designed to create pressure and urgency. You can simply say you're not interested in providing that information right now. The call ends. Your accounts stay open. Banks are not evil institutions. Credit cards, loans, and bank accounts are tools that help us participate in the economy. But banks are also profit-maximizing entities that treat your data as a resource to be used. Understanding that doesn't make you cynical, it makes you informed. The next time that income update pop-up appears, you'll know exactly what's happening. The bank wants fresh ammunition for algorithms that optimize their profit, not your experience. Close the pop-up. Keep your information to yourself. Let your payment history and responsible behavior speak for you. That's the data that actually matters. And unlike your stated income, they can't get it just by asking nicely. I'm Tara. If this video opened your eyes, share it with someone who needs to hear it. Drop a comment below telling me, did you ever update your income when they asked? And if you haven't already, subscribe for more videos that put you back in control of your financial life. I'll see you in the next one.